Ladies and gentlemen, if there is one thing that I can teach you that has been on display for the last few weeks, it's that earnings do not matter. The reaction to earnings matter. My name is Hamilton. I'm here with the Trading Initiative, and over the next 3 minutes, let's talk about this simple concept that can hopefully keep you guys out of trouble. So the big narrative over the last few sessions has been, is the market bottomed, right? Was that it? And I don't think so. I think I've made it very clear that I think that there's a bigger pullback coming, particularly in tech and semiconductors, and I don't really think that this recent rally over the last few sessions is sustainable, at least not yet. Market internals have obviously propped up since Friday. We saw more highs than lows. We saw equal-weighted S&P 500 and the equal-weighted Qs, at least today, pop up green, and over the last few sessions, that S&P equal-weighted has as well. Stocks above the 50 and the 200-day continue to creep up, but is it enough to really say that this breakdown is over? And I really don't think so. You know, one of the biggest things I look for inside of these corrective phases to be over is that momentum regains to the upside. The bears are exhausted, and I just don't see that in terms of momentum indicators. Obviously, we've reset, but we can oscillate down here for an extended period of time. As you see, last year we oscillated there for over 3 months. So until we're back up and over the 50 RSI, we're breaking some levels to the upside. We're on the other side of these earnings reports. I'm not ready to say it's time to buy the dip in tech and semiconductors and everything else. I've been very transparent about this. I've been sitting on the sidelines. I'm not interested in shorting this and trying to make $1 trillion on some short-term moves to the downside. I'm fully vested in being long this year, but I'm not going to sit long and continue to buy dips and things that are not working. One thing I want to point out to you guys, once again, as we brought up at the very beginning of the video, the reaction to earnings matters more to a technical trader than what the actual earnings says. And there's no greater example than JP Morgan. This was kind of our red flag going back to April 12th. JP Morgan reported and they double beat. It was a really good earnings. It was actually one of the most profitable earnings in recent history for JP Morgan. And yet the stock gapped to the downside, and over the next few sessions came all the way down about 8% total. Now, over the last few sessions, JP Morgan has rallied. Financials have looked really good. We actually just put another financial name in our positions book today. We bought a new one that was breaking out. If you want that type of trade and all of our trade ideas, link is in the description below. Join our community. You can have access to all of our market research, including our trade ideas. You can take these with us, but we're back long financials. We're adding into strength here because they look good, but still JP Morgan got hit on April 12th and it pulled back nearly 8%. That's a huge pullback for a large cap bank stock, particularly JP Morgan, which is like the flagship banking stock, right? Over the last few sessions, we've filled the gap, potentially flirting with the new all-time high in JP Morgan, but the reaction is what we're interested in. Why did JP Morgan get sold off even though they double beat? That to us was risk-off mentality. That was completely different than what's been happening over the last 6 months, right? JP Morgan gapped down on its previous earnings and immediately rallied to the upside. Did not have an extended drawdown, which ended up being, like I said, an 8% drawdown. This is risk-off to us. Back on April 12th, we realized that the dynamic has changed. Earnings, even though they are coming out and they are good, are now being sold off. And it wasn't just JP Morgan, right? It was Netflix. Netflix had good earnings. Gap down. It was Verizon, which we had a trade on and we got stopped out of. Absolutely destroyed with good earnings. I mean, over and over and over, there's these companies that are reporting and they're just getting killed. So once again, I'm not generally surprised that Meta's getting killed. From what I can tell, the earnings were pretty okay. Somebody that's a lot smarter than me, that wears a tie and walks around and pretends like they know everything, is probably going to tell me why Meta sold off. But they also don't know why Meta rallied like 300% as well. So it's always a catch-22, right? When they're right, they're very right. When they're wrong, they're still right. They just want to bullshit with you. Either way, I don't necessarily care about what earnings said. I care about the reaction earnings. And this does not surprise me to see Meta gap down because friggin' everything has been gapping down, even on good earnings. So once again, guys, if there's one thing I can teach you, it's that the reaction to earnings matter more than earnings themselves. We're in a completely different market environment than we were over the last 6 months. We figured that out April 12th when JP Morgan gapped down. And cash is a position. You don't need to be shorting stuff if you don't want to. We're still in a primary uptrend, even though Meta is down huge after hours. And don't get me wrong, if you shorted into this, you're going to make a lot of money. So congratulations. Meta is down 15% and threatening to fill the gap. I guess the one good thing here is there's yet another gap to fill in Meta. So congratulations. You might be able to buy that eventually. As a matter of fact, I do think we're going to be able to buy Meta eventually. As with most of this stuff, I think we're going to be buying these eventually. But once again, reiterating what I've been saying since friggin' Friday, we're not in the mode yet to be buying the dip in this stuff. We're buying areas of the market that are breaking out into new highs, energy and financials. We are not buying the dip yet in the Mag 7 stuff. particularly in the tech, consumer discretionary, or communication space. We just don't think that it's ready. We need to see more of a push from the bull side, and we're just not seeing it yet. Guys, my name is Hamilton. I'm here with the Trading Initiative. Hopefully you like these kind of daily little updates, 5 to 7 minute videos, kind of giving you my general thoughts on the day. Once again, it's going to be time to own this stuff, but not yet. If you like this type of content, please like and subscribe. Leave a comment below. I'll catch you tomorrow.